Okay, great, cool. So we're gonna give another minute for everyone to kind of pile in here. We've got some new stuff to be able to share with everyone today, which I'm super excited about. In terms of where we are, while we're waiting for everyone to kind of pile in, why don't we start with where everyone is based? Where you guys located? Where you guys joining us from? Where in the world? So who wants to go first and drop it into the chat here? Cool. Naples, Florida. Got from Eric. Sweden. All right, cool. Naples, Sweden, Sao Paulo. Yeah, Helena told me we're gonna have some folks from South America on tonight. Super excited. Texas, Fort Worth, Napa Valley, California. Hey Darius, what's up? Cool. Southern California. By the way, so you know, I'm originally from California. I was born in Berkeley. I don't know. I'm 37 now, so it was a long time ago. And so most of my life in Baltimore. Now I live in Israel, where most of the Solid Block team is. Cool. More Sao Paulo, Brazil, San Diego, Little Rock, Arkansas, Philadelphia. Awesome. Awesome. Cool. Very, very cool. So we're going to be covering today what we're starting to kind of really hone in on, right? The 5 core benefits of what tokenization can do and how it's going to position assets for the coming changes to the blockchain economy and the overall economy. If everyone's following the news today, things are taking a major hit with the new CPI numbers. And again, it's just an indicator of how things are going to be continuing to change, and technology will continue changing, even when things are going to dip temporarily. It's usually technology that winds up coming back and winning in the future, and getting ready to, getting things ready for that change now is going to be absolutely critical and key. I'm super excited to be able to share with everything what we're going to be talking about today. So the 5 core benefits, real quickly, my name is Gavi. I'm the head of marketing at Solid Block, and we are a tokenization as a service company. We focus on helping asset managers, fund managers, asset owners to be able to tokenize their assets, which basically means moving their ownership over to the blockchain, fractionalizing it, turning them into tokens, which gives them the ability to be able to manage their asset more easily, which we'll get into, as well as also get access to DeFi loans and other things, which we'll also get into as well. I usually break it down kind of like this. Like usually when it comes to any type of product or service in a business, there's basically 2 kind of categories that that product will fall into. Is either something that's going to make life more efficient and save money, or something that's going to help your business grow, right? So what we're going to be talking about today is how you can do both of those things with tokenization. Excuse me. And so let's get started. The first thing I do want to say, really important, and I've talked about this in the past, which is that tokenization is not a capital raise function. A lot of people think it's connected to crypto, and they make kind of the connection. Oh, this is a way to kind of to get money from my my raise or whatever I'm looking to do. It's not a raise function. It can be used as part of the raise process, but if the underlying asset is is something you're having trouble raising money for without tokenization, you'll have trouble with it with tokenization. But when it comes to tokenization, and you have a good deal in place, tokenization basically just kind of adds fuel in that fire and makes things all the more so. So the 5 things that we're going to be covering today in terms of asset management, we're talking about using tokenization, the core benefits of tokenization for streamlining asset management. So this is post issuance, or at the issuance phase and post issuance, streamlining capital raising. And I'll say we're not talking about actually raising capital, but we're talking about streamlining the functions of it. We'll get into details about exactly what that means. Talking about custody transfer, again, of issuance, of sales, of things that happen after the funds have been raised. And this one's a new thing we're going to be talking about, and this is what I'm really excited about to be able to talk about, which is preparing for DeFi, right? Using those tokens to be able to access the world of decentralized finance and all the other benefits in terms of using it for loans and collateral and stuff like that. We'll be talking about a bit about that later, as well as also by moving things, making things digital, moving them onto the blockchain. It allows you to get a lot more insights into the data of what you're talking about. So we'll talk the data of what's going on with your asset, which allows you to make better decisions overall for the business and etc. So we'll be talking kind of details of each of those things, but those are the 5 things we'll be talking about today. So let's talk about the first one, which is streamlining asset management. So in terms of streamlining asset management, When it comes to the point where if basically after you raise money, and basically after somebody becomes an LP, they go through the process of that. There's a lot of reporting compliance that has to happen, right? We work within the SEC guidelines just to understand like the way that the tokenization model works. Hold on. Red Swan CRE. Hello, everyone. So the way that the kind of the process works, right now, the crypto in an overall sense is in a gray box regulatory wise. The Gary Gensler, who's the head of the SEC right now, has basically come out and said that Bitcoin is he considered to be a commodity, but everything else is the question if they're going to be securities or not, if they're going to fall under securities laws. Now, we don't play in that realm at all. One of the things that's kind of really unique about what we do is when it comes to tokenization is we're working within the SEC guidelines. All we're doing is taking the existing asset and whatever the regulatory framework is that we're able to raise money and sell that asset to investors in, we're just moving that over to the blockchain. The way that works is we'll have a PPM that will define the details of that deal, and then as part of the process, what we do is there's an addendum that's added to that PPM, which enables the digitization of the PPM, right? So that's what is the legal framework that enables you to move the details and the rules and the laws within that PPM over to tokens and to a smart contract that can execute on those tokens or execute on that PPM and execute on those deals, right? So this is all within the regulatory framework. Again, there's a lot of work that needs to happen, usually paperwork. And when it's moved over into the kind of token and smart contract realm, it makes things a lot easier to be able to manage. Things are automated, and you're able to, just in terms of automating books and records, keeping things accurate, keeping things up to date. This is something that can potentially save many firms tens of thousands of dollars a year, but just by being able to cut out or reduce the reliance on third-party compliance accounting services, because everything's done automatically on the blockchain. So the interface that we're developing, we're calling it Token Suite. And Token Suite is basically going to be, and my hope is that in the next 2 weeks, we're actually going to be able to be sharing some of that with you, what that looks like, what the interface looks like, and how we're going to be able to streamline and guide someone through the entire process of tokenizing assets, being able to manage the assets, managing the LPs, being able to then transfer out as needed, whether they want to use those tokens to get loans, whether they want to transfer to a secondary market for trading, et cetera, stuff like that. So this is also going to be part of it. Is going to be giving you the tools you need to track all your books and records, and then making compliance and reporting even easier. So that's going to be that's really core benefit number one, which is streamlining your asset management. Core benefit number two is streamlining capital raising. I'm going to define what I mean by that. I'm not talking about actually raising the capital, but think about what happens after you have someone on board. So the average number, according to Ernst & Young, to onboard an LP is 41 days. So once you have somebody who's getting onboarded, the average time is 41 days with a lot of phone calls, with a lot of emails, a lot of back and forth to get their information. And part of what's integrated into the Token Suite software is automated KYC, AML accreditation, and input documentation. So the overall streamline to actually get everything in place is touchless. It winds up being touchless because it guides the LP to onboard themselves. Obviously, they can always reach out if they have questions, but it guides them to be able to onboard themselves into the system, to be able to take advantage of or to become an LP in the offering. And it can happen in less than a week. I'm going to say something I was probably told not to say, but I'm going to say it anyways. I was told it can be done in as little as 3 days, but let's just say it can be done in about a week. Right? Basically, you take the average time from 41 days down to a week to be able to onboard people. It's a better experience for people who are coming onto your offering, into your deal, and it definitely is going to save a lot of headache down the line. And to be able to make also your LPs happier as they're onboarding themselves into it could be a new relationship, who knows, and to be able to streamline that entire process. So that's really the key point, is that you're streamlining the onboarding aspect of capital raising, right? Once you have someone in place, right? Also, and the important thing also, onlining and streamlining fund collection from them, making sure that once they're onboarded and all the compliance is in place for them to be able to receive their funds. In our system, we were able to receive funds It could be either in fiat or it could be in crypto, depending on what they're looking to give forth. And the idea is that we want to streamline this entire process. We want to be able to cut this down so we can focus more on doing the really important things in our business and less having to chase after people so that they can update their passport imagery on getting them on board, as well as also increase accuracy for that entire process. One thing also important to know about tokens is usually, now Solblock has generally been dealing with a equity side of deals where you tokenize the equity of things, but it's also important to know that you can also tokenize the debt, tokenize the other side of the balance sheet of everything as well. And that's all going to be kind of baked into when you're onboarding the asset, or you're onboarding, whenever you're onboarding for the tokenization process, you'll be able to just, choose whether this is going to be something that's going to be equity or debt in terms of the tokenization. In terms of number 3, so keep in mind what happens right now. Here's how the process works. So once the asset's onboarded, you're going to issue your tokens. The tokens are going to be minted, and once the tokens are minted, you have to execute and create a smart contract that's supposed to define, again, whatever the legal framework is for this deal, right? So whatever the allocation that someone is supposed to receive, whatever dividends or yields that they are supposed to receive, that's all written generally in the PPM, and that all then gets digitized in the smart contract. Then when someone is holding those tokens, they're holding those tokens, right? So one of the things that happens is let's say there's distributions, let's say there's yield. We're not quite at the yield stage yet, but the distribution stage, how do you calculate that? So all that winds up getting calculated with the smart contract, and you can now transfer either additional security tokens or USDC directly into the person's wallet. So you can transfer things into their wallet. Again, it's all done in a much more streamlined way than kind of the traditional way of doing things. Those tokens themselves also, so again, explain this process. So in the United States, there's a 1-year lockup period. This is according to SEC rules, that someone is not allowed to be able to transfer those tokens after they receive them. So there's a 1-year lockup period. Once they do that, though, they can move that onto an exchange. We generally work with T0, INX, and they can then trade those tokens just like you would in any crypto exchange. But I see there's some questions coming in. I'll get to the questions at the end, next few minutes. I'm happy to answer any questions you guys have. But if you want to, feel free to drop them in the question area. I'll get to them when I'm done here. Right. So again, custody and transfer. Right, being able to allow your LPs to take custody of their tokens, allowing them to transfer to someone else, to another accredited investor. And this is actually kind of a cool component of the smart contract, is that, again, legally, let's say someone would not be allowed, for example, to sell his token to a non-accredited investor. But what you can do is, let's say that you can say to the person, hey, go over to either Token Suite or Solidblock's platform, or go over to another exchange like T0, INX, or one of the exchanges that we have a relationship with, go through KYCAML, add your wallet. And now what happens is, because you're on one of these 2 platforms, that wallet gets whitelisted to show that it's attached to an accredited investor, and then he will be able to then transfer those tokens directly over that. And what the mechanism that's in place to make sure that someone doesn't do something they're not supposed to do is done via the smart contract. The smart contract will be able to define if this this person is not an accredited investor, and therefore they would have to go through that KYCAML process. But if they are, they can transfer just like anyone would anyways, with transferring crypto. This is a way to be able to use and leverage the ease of transference within crypto, as well as being able to stay compliant as needed. One thing also I want to now talk about here is also, again, I mentioned it briefly, but again, automated yield and distributions, once again, calculated within the smart contract, and then automatically uploaded and sent into the person's wallet when every month or every quarter, whenever the NOI is calculated, if it's a yielding property, for example. So now I want to move on to, this is a cool part. This is something that we started talking about. It's just the DeFi lending aspect of things. So right now, this is only available for institutions. So if you have any institutions on here, this is definitely the time to pay attention. But then we're working on a partnership with someone. We should be announcing it soon that will enable anyone to do this. And this is why the benefit of tokenizing now, to be ready for not just this coming thing that's going to be happening, but lots of opportunities are going to be coming their way in terms of lending. But one of the things that having the security tokens enables you to do. It enables you to lend it out on one of these DeFi platforms. And because your token is representing a real world asset, right? You don't have the fluctuations in price that you have right now in the general crypto market. The general thing that's driven a lot of volatility in the crypto market in the past few weeks has been, people don't know how to value this asset class, right? So that therefore there's wild swings in price. So I usually break it down. It's like you have your Bitcoin and your Ethereum, right? These are crypto assets. This entire asset class is in price discovery right now, right? That's why there are such swings in price at the moment. The utility for many of these coins are still in development, are still trying they're still waiting to see what the actual result of it's going to be. But where that goes in terms of security tokens, it doesn't really impact us. Again, we're working on the same rails, so we're both building on top of blockchain. But the asset that's built on top of the blockchain, whether it's Bitcoin or Ethereum or Solana or XRP, right? It's not the same thing that we're doing with security tokens. What we're doing is we're using blockchain rails, but the coin price is driven by the same way you would drive the price of an asset, a real world asset today, right? So you have a property. Right, that property has a price. There's a process to discover the price, and then the token is represented whatever the price is divided by the number of tokens that you have, right? So that's how that works. So you're not going to have the same issue that you'll have, but you will be able to get access to the same technology that DeFi will enable you to do. And there's lots of platforms out there, people who are willing to lend money, right, using your DeFi's or using your tokens as collateral, right? Get interest on that. Or they earn interest on that, and the benefit also for everyone really is these are people who wouldn't normally have been able to have access to a real world assets collateral in the past. Because let's give an example, right? Let's say you have a $10 million building, right, and you need $1 million. It's going to make it simple, right? So you go and in the past you could say, hey, loan me $1 million, right, at whatever interest rate that might be. If I default on that loan, all the people lent me money now I need to go figure out how to go sell my $10 million building to liquidate it, to get the money distributed out. It's a pain, it's a hassle, and it's many cases frankly not feasible. But when you have the tokens, first of all, you have a lot less risk because you're only giving 10% of the asset, right? You don't have to worry about giving up the whole asset. But when you then give those security tokens, and if there is a concern that you do default on your loan, they just liquidate those tokens, and it's all managed by a smart contract. So everyone wins. For the person who wants to get the loan, who's using their asset as collateral, is able to get access to funding and deals they never would have been able to otherwise. They don't have to deal with banks, right? It's all managed on DeFi protocols. And I will just one thing also just I'll mention, just be aware of in terms of the overall kind of crypto market. So there's something called CeFi and DeFi, right? Centralized finance and decentralized finance. The things you've been hearing in the news lately about Celsius, 3 Arrows Capital, these are all CeFi companies. These are all centralized finance companies. They're essentially they're blockchain based startups that are playing outside the rules that banks used to use 100 years ago, and now there's rules regulating against that. But when it comes to DeFi, things are extremely better managed because it's decentralized. There is no one making. Greed isn't driving the system. The greed is balanced with the risk proportionally, and it's a significantly safer place to be able to do this. And so that's basically how that works right now. So right now, the partner that we're talking with right now is only offering this right now to institutions, but the goal is eventually this will then be able to be offered to anyone. So anybody who tokenizes an asset will be able to get access, using their asset will be able to get access to collateralized loans and collateralized deals, and to be able to use, let's say, for example, to buy another property. I do exactly the same thing and start to kind of build up and scale up that way. And that's this is kind of a great scenario. Everybody wins. And that's coming. And by tokenizing today, you're getting ready for that change, for that big hump that big move is going to be coming on the very near future. And that's going to be and that's very exciting. Okay, so that's number 4. Number 5, right? Data and analytics, right? So because things are done on the blockchain, transactions are transactions are settled very quickly, which means you get real-time data about things that are going on. What's the price of the token, right? Data on your LPs, other information and data information you might have, because the data is all at your fingertips. It allows you to be able to make data-driven decisions about what the next steps are going to be. This portal, particularly, I'll say, is currently being built out. So if you actually have anything specifically that you would like to be able to see, let us know, and we'll definitely include this in the product spec and include this in the first version for when it launches. So to recap, we talked about the five core benefits and reasons why people should be thinking about tokenization right now. The first one is streamlining their asset management, making asset management easier, more cost effective, less of a headache. Streamlining the capital. I wrote capital raising. It's not really capital raising. It's more streamlining onboarding of LPs and receiving funds. Making that faster and seamless, and being able to do compliance, KYCAML in less than a week instead of 41 days, as well as receiving funds in a much more seamless manner. Number 3 is custody and transfer, so having a lot more optionality in terms of moving these tokens around, moving shares around of the asset, people being able to buy, people being able to trade, people being able to sell it as needed, people being able to take advantage of the fractionalization nature of tokenization. Number 4 is preparing for the DeFi world and all of the tremendous opportunities that are going to be coming as this continues to develop, including some things that we'll be able to even start doing very, very soon when it comes to loans and lending. And the 5th is to be able to get data and analytics and be able to understand details about the asset, about your LPs, to be able to make better data-driven decisions for the asset and for your business going forward. So that is what I got today, and I already see people have a ton of questions. I'm going to jump into this in a moment. Okay, just a moment. Let's open this up here. Okay, anonymous attendee. All right, anonymous attendee, I gotta know who you are before I answer these questions. Well, fine. Just to answer the questions, what blockchains are your tokens minted on? Anyone wants to know? It's Ethereum. It's Ethereum, Polygon. It's not a that's the foundation for blockchain that most people are building on today. In terms of distributions, we're talking about being able to do payments, right? So if you have if a property value goes up or there's rental income and you want to calculate that, you have to be able to then pay your LPs. So you can do that within the system. 1-year lockup period is just in the US. I don't believe it's anywhere else, specifically in the SEC. Just the reason for that is because the SEC basically wants to protect the retail investor. So basically, as an asset becomes more real, there's more things known about it. Obviously, the risk level goes down, and the reward goes down, but the risk level goes down as well. So that's why they generally have a 1-year lockup period, particularly for an early stage build or a raise. What assets do I foresee will be tokenized in the next bull run? Land, house, everything can be, like right now, like real estate, I think, is the most common one that can be done. But again, anything that can be sold, keep in mind that tokenization is a technological framework, right? And it's the legal world that enables that framework to exist, right? So as long as you have legal ownership some way, you can move that ownership, using documentation, move that over to the tokens, then the tokens can be done, with anything. Okay, what if tokenized asset generates over time? How do you envisage distribution of token holders? Right now, USDC could be either USDC. Someone can choose to get paid in Bitcoin, whatever they want. That's how that would work. We're exploring also to see how we can also do automated distributions into someone's bank account as well. Can you tokenize a Delaware C Corp company that has publicly listed token? Can you ask that question again? I'm not sure what you mean by that. All right, so let's take a look here at so I'll tell you, this is the problem with Zoom. They have 2 chat windows, right? And there are people asking you questions in both windows. All right, how does your security token differ from an NFT? Okay, so once again, this is a thing that's important to understand. I remember talking about this on my last webinar, which is that, again, the key point here is to understand the legal framework is I'm moving the ownership from, you know, the what's it called, the SPV, the legal entity that's housing this asset, right? Instead of me buying shares, the shares get moved over to tokens. They could also be moved over to NFTs, right? There's like, as long as the legal documentation says, okay, this NFT is now a digital representation of this share. Whoever owns this NFT, whichever wallet is, whatever the details are, right? It could work the same way, right? The difference between NFT and tokenization is that NFT is like, it's not fractional. If you own, I mean, unless you want to own, you know, 10,000 NFTs, yeah, maybe you do, but there, again, you could do NFTs, you could do tokens. Doing it as a token is generally much easier for what we need. If there is a specific use case, and I'll tell you, Solid Block recently, kind of as a secondary business, we recently launched an NFT product for hotels, right? So hotels are going to be able to, not related to securitization or tokenization at all. It's just one of our clients who wanted to do this, and we said, and basically what they wanted to do was they wanted to be able to offer NFTs for people to be able to redeem to get hotel stay packages in their hotel. It was very successful. We have a lot of interest as well already from that launch. It was picked up by Reuters and Hospitality.net and Rob Report and Yahoo Finance and a bunch of different places. So, all right, is there data limitations as what can be incorporated attached to the token representing a property interest? Oh, this is why you're asking it. This is why you're asking about the NFT. So no, it's not. You're not really attaching. You're not really attaching the. You know what? Yeah, I don't want to answer that question. I want to ask the tech guys to answer that question, because I think there actually is a way to do it, but I don't want to give a straight answer to that. I believe there is, but again, whether it's NFT, whether it's a token, right? NFT, you'll be able to do that. You can maybe tie the NFT to the token, or like you can do it. There are ways to do it. Like it's not a problem to be able to do that. You know, keep in mind, really what you're doing is the tokens are representing shares in the LLC that's holding the asset, and that's what that's really holding, right? If you want additional information, okay, you can figure out how to incorporate NFTs into that. But I think there also might be a way to attach imagery and stuff to the tokens. That's a tech question. But if you want to shoot me an email, I can get in touch with my tech people and get you an answer to that question. What are the conditions where non-accredited investors will be able to directly purchase, trade fractional tokens? Can you elaborate on KYCAML? Okay, so KYCAML is a banking term. All banks in the Western world are required. If someone kind of onboards into their bank to go through this process, KYC stands for Know Your Customer. AML stands for Anti-Money Laundering. Basically, we have to know who this person is. We're going to allow them to do business with us in our bank, to make sure we're also not enabling them to launder money and do illegal criminal activity. So basically, you have to know who they are. That's what KYC AML is. And particularly if you're going to do like a Reg D 506C, where you're doing a raise with a larger number of people, if you do some type of crowdfunding for your asset, particularly, then you know, like, you can't onboard any individual person. If someone's, you know, just getting two people to fund their asset, like, okay, like, you know, you don't need to you don't need token suite, because, okay, fine, you'll take the time to go through the process with them. Usually because they're giving you a lot of money to be able to do that. But when it comes to particularly a larger number, people giving lower amounts, you want to streamline that process, and they have to go through KYC AML for you to be able to legally give it to them. In terms of the accreditation, so I'll explain a bit about that. So accreditation in the United States is defined as somebody owns it's $1 billion worth of assets that doesn't include the home they live in, and I forget if it's or if they have to do both or just one of these, or they've made over $200,000 a year for the past 3 years. Right. Basically, the point is that these are indicators to show that people are educated enough about money that they'll be able to make a good investment decision in things that are, you know, again, quote unquote, more risky for everything. So the point where you'll be able to sell this, I didn't even talk about this, but one of the other things you can also do with the DeFi DeFi world is eventually you'll be able to make other financial products. So if you have multiple properties, you can now go make an index coin of all your properties. Now, the index coin is something you have no problem selling to retail. That's not a problem to sell to retail at all, because the risk is spread out. on that thing. So again, I should be careful what I say. It's likely not going to be a problem. It's likely not going to be a problem because it's an index coin, but like that's something you'd be able to then sell to retail, eventually put on some type of a exchange. Oh, good question. All right, Bill, Goldman Sachs. So let me just actually check. One of the analysts actually sent me a message right before our call. I want to see what he sent me about Goldman Sachs. So Goldman Sachs is right now very heavy on getting ready for tokenization and blockchain stuff. And he said, here he said, basically fine. So this is one of our analysts who actually spoke with somebody in Goldman Sachs digital team a few weeks ago. And basically they said that there is a firm-wide mandate to review and research any blockchain project, that they're very serious about the integration and movement over to blockchain right now. JP Morgan is as well, although they're being a little bit quieter about it, just because Jamie Dimon has blasted Bitcoin and blockchain products for the past few years, so he's got to save face a little bit. But like this is coming. They know this is coming. They know this is getting ready, and they know they're getting ready for it. Like again, in my other webinar, I went into the details about the history of understanding technology and how it kind of adapts. Like these big firms know this. I can tell you this, one of my previous jobs, I used to work in and give innovation presentations to these Fortune 200 companies to be able to talk to them about how to spot where innovation is going to be happening right now. So like they understand this. They bring in consultants, they bring in people and the knowledge to be able to understand like where are things going, how to react, and they understand this, and they are getting ready for this, right? So that's any indication about kind of where the sails or the winds are blowing. That's a good one. Okay. Why is Goldman Sachs getting ready for this? Because they know that this is where things are going to be moving to. I can't go into the details on this. I got to think about that. Maybe on another webinar, I'll go into more into the nitty gritty underground details of what's going on with the banking system to understand why they're getting ready for this and everything. All right. So what's the difference between a smart contract code and smart legal contracts? When you say smart legal contracts, I'm assuming you're okay. A smart legal contract means your lawyer is not dumb, and like he actually it's a smart. He wrote you a smart legal contract. Like it was smart. It was strategic. And a smart contract code is basically taking that legal framework and digitizing it. So again, it's important to understand. Like this is something again, it's a really important distinction to make. Technology does not solve problems that couldn't have been solved with more money, more time, more work otherwise, right? Like I think that's a really important point. Like you can go back to things like the steam shovel, right? Like something as rudimentary as that. Like the steam shovel just dug a hole better and faster than a man would have with a shovel by himself, right? So like it's allowing you to do things that's better, faster, smarter, stronger, right? But the underlying thing that needs to happen still usually is getting done somewhere else, or it's being ignored totally. But that's usually the underlying point. So like again, you have a legal contract that's supposed to represent your asset and it's supposed to represent the ownership and it's supposed to represent the who gets what in the deal, right? That's a legal framework that needs to be drafted as usual. But then when it comes over to the tokenization part, the smart contract is executing that contract. It's not creating the contract. Now, eventually we'll get there. Well, eventually, like this industry is going to evolve. I think in the next 10 years, this is going to impact the legal industry, I think, significantly in the next 10 years. In terms of like as things start to become more standard, and if you plug AI into this might be a whole other startup that people can get into to be able to start automating legal contracts, then executing them on smart contracts. So I think that answers your question. Okay, let's see. Maybe this is too granular, but tax credits follow the token ownership, or is that something the IRS would have to opine on? Or B, if the token is subject to an applicable holding period. Trying to understand what you're asking me here. Okay, fine. So can tax credits follow the token ownership, or is that something the IRS will have an opinion on? I don't know the answer to that question. I don't think I can answer that question. I don't know if you want here 5-year hold requirement. Are you talking about holding tokens? Like, what are you talking about? You're like, you're talking about like, okay, fine. Give me a scenario here. So is a scenario here like, like that if you hold something for a certain amount of time, you get certain tax credits? Is that what you're talking about? Because if that's the case, the answer is yes. But yeah, exactly. So the answer is yes, because again, keep in mind what tokenization does is, again, if the rule exists in the real world, tokenization doesn't make that rule go away, right? It's not like all of a sudden now we're doing tokenization and all of a sudden we can, the IRS and SEC rules don't apply anymore. Like, no, that's not the case. So that's important. Like, yeah, exactly. It's not through custodial. Exactly. All right, let's see here. Now I'm going back to window number 2. Hold on. All right, let me ask this question. In the future, would you guys add businesses tokenizing infrastructure, meaning that instead of them taking a loan from a bank? Okay, so yeah, so I'll tell you, it's not on the current roadmap, but I've spoken to startups who are like, we should tokenize our startup, right? In terms of being able to raise money and just being able to kind of manage the cap table. Like, you could do all this with tokenization. So I think in the future, like right now, the biggest I think opportunity is real estate, because real estate is a huge industry. People are doing a lot in there, and it's very rigid in terms of its currently how it's formed, or how it's managed, right? So by starting with real estate and other kind of real world assets, that's what we're starting with. But I think in the future, I think 100%, yeah, tokenizing other infrastructure, other aspects, right? You have a scenario where someone could tokenize their barbershop, right? So they tokenize their barbershop and decide, I own the building, I own the cash balance on the balance sheet. I tokenize that line on the balance sheet, right? Like there's a way you could do that. You tokenize the cash line on the balance sheet, and be able to get a loan with that. With that, for example. What are the risk financial obligations to the property owner to token holders? What's the risk financial obligations to the property owner to token holders? There's a decrease in value of the asset due to market conditions. So again, Greg, I would answer you like this. If you didn't have tokens, okay, like there's talks right now, there's going to be a real estate drop in pricing right now across the board, right? As stocks and crypto are going down, they're saying that the housing might be next, right? So forget crypto for a second. The same scenario applies, right? The same scenario applies. So again, and keep in mind that what's driving the price of this is is the regular way you evaluate the asset today, divided by however many number of tokens you have. So the token value is representative of the original business or the original asset cost divided by, again, the number of tokens. So that's the way that you would think about that. Okay, cool. So we've been going for 40 minutes. Let's take, is there one more question? Let's take one more. Let's see here. I got Olivia. Let's see. Are there any conditions where the SEC would not require 1-year lockup period? I could trade a token after 6 months of purchase. Do the parameters change if I'm purchasing tokens after the initial tokenization of an asset form for an individual? Okay, fine. Yeah, that's an important clarification. So to answer your first question, the answer would be outside the United States. Right now does not require that 1-year lockup period, I believe. And so if you're selling your tokens to someone else, they would be able to do that, but they would not be able to sell their token to somebody in the United States. Again, that's why, right? So again, KYCAML, anyone who's going to be like, basically you're making like a little network amongst yourself in the tokenization world, which is going to grow. If you understand the power of network effects, as this starts to grow, like this is going to exponentially grow, this network of KYCAML wallets. So they wouldn't be able to actually transfer that token to an American person, but they would be able to do anywhere outside the United States. So do the parameters change if I'm purchasing tokens after the initial tokenization of an asset? But do the parameters change if I'm purchasing tokens after the initial tokenization of an asset from an individual token? Yes. Okay, fine. So so you're touching on a point, and maybe I missed this, is defining the primary and the secondary market. So everything I'm talking about, the 1-year lockup period, is referring to the primary sale, right? Once you're getting to a secondary sale, afterwards, that 1 year holdup does not apply anymore. So if you're just tokenizing an existing asset, you're not looking to raise money, right? Let's say it's yielding, for example. You just want to give ownership away and get some money for it. I don't know, whatever you're looking to do, would not require that lockup period. So because of the KYC, there are transfer limits versus traditional sale of actual real estate. There are transfer limits versus traditional sale. Well, no, technically it's the same thing. Technically, okay, fine. So I gotta let's clarify this. If you go find, some Joe Schmo down the street, right, who's not accredited, you can go into a real estate agreement with him, right? That's not a problem. Probably even do tokenization with him, because again, the point is that you're bringing it in. You know who the person is. The point is you're going to go out and solicit investors, right? And solicit. They have to be accredited, and they have to be, and the system has to be able to work within the limitation of being able to work with accredited investors. All right, guys, our time is up. This has been absolutely awesome. If anybody has any specific questions afterwards, feel free to email me and I'll either answer you or I'll pass it on to the appropriate department to get the answer for you. This recording of this webinar will probably be up, what's today's Wednesday, so it's probably up either tomorrow or Monday. We'll see what's going on. Thank you, everyone. Thank you, Brett, Eric, awesome. Appreciate everybody, and I'll talk to you guys all later. Oh, actually, one more thing I'll just mention. If anybody here is thinking about tokenizing, would like to speak to one of our sales reps, you can go to solidblock.co. There's purple buttons all over the place that says tokenize, and you can fill out, let us know some information about your asset, and we'll schedule a call to see if this is a good fit for you. All right, we'll talk to you guys all later. See you later. Bye.